Here we are again today. We thank you for watching this video. This is part of CalvertHealth Foundation's Financial Wellness Series. My name is Bill Gaines. We're here with Jim Fleshman, CPA from Lombardo Ayers, also the Managing Director, Tax Director there at the local Prince Frederick office.
Correct. Yes.
Jim, we thank you for coming out today. As I always say, this financial wellness is something we've been doing for quite a few years now with CalvertHealth, and we're not only worried about folks' physical health, we're worried about their financial health as well, because that's a big part of what causes stress within their lives. If they're not financially savvy or financially well off, or say well off, their wellness financially is big.
100%. I mean, we see that all the time. I mean, part of it is taking care of your body, but it's also taking care of your wallet and your finances, making sure that's in order. And it's something that I've instilled upon our team, is that, we have a responsibility that's second to a doctor. We're a trusted advisor. I mean, we know very intimate details about clients and their financial situations, and that's not something to be taken lightly. So I always view what we do in line with the medical field, just making sure that the taxpayer, the client, is taken care of in all ways.
Good.
Yeah.
That's huge.
Yeah.
Well, one of the things that as we get near the end of the year, and I'm a financial advisor and financial planner, so clients have to take their annual required minimum distributions, right?
Yeah.
So the IRS is telling them that they have to take it because they hit a certain age. We use the acronym RMD a lot, which stands for Required Minimum Distribution. But can you just kind of give us an idea of what, so people out there know, do they have to take an RMD now? Do they not? They've heard about the age changes.
Yep. So we've been in a state of flux. Secure Act 2.0 caused changes to when we take the RMD. So right now it's 73.
Okay.
So it was 70 and a half, then it was 72, now it's 73. And like all good things in tax, it will change in 2033, where it's going to go up to 75.
Okay.
So what that RMD is, and as you said, required minimum distribution, what that says is that I have to take out of a retirement plan.
If you're not already taking something.
I am required to take that. So what that gets figured out is by people far nerdier than me, actuaries who look at the life expectancy table, they look at the fair market value of the account, and they determine and tell you need to take out X dollars, by next year.
Yeah.
So what I think it is, it's important to think about when you have to take that. More often than not, that's ordinary income. That's taxable to you. And what we're going to talk about, federal and state, and what we're going to talk about here is some ways to, get creative with the required minimum distribution that you have to take.
Yeah.
So.
Yeah, because there's other ways that folks can actually take some of that money and maybe donate it to a charitable organization, and we'll talk to that a little bit.
Yeah.
So if I have an old 401k, I have to also take it from that as well. Is that correct?
Yeah. So it's
retired, but I left it in a 401k. Right. Didn't move it to an IRA, that sort of thing.
Right. So that would be under that. That's under it. And one of the things that I've seen over the last year that's come up is people are moving to like self-directed retirement plans. Mm-hmm. And then they're forgetting it.
Yes.
So what happens is when you work with a trusted professional like Bill, you're going to get, kind of pinged at this time of year. I'm sure you're doing that with your clients, saying, Mr. and Mrs. Smith, you need to take out now.
Yep.
You have a required minimum distribution. But that's just a word of advice that people have these self-directed plans, and they are missing those required minimum distributions.
Because Mr. IRS can penalize you if you
you can. And Mr. IRS has taken his tone down a little bit.
Okay.
We were at a 50% penalty. Now we're at a 25% penalty.
That was part of some of the changes that they made.
Secure 2.0.
So 25% of what the amount that they
should have taken.
Wow.
Yes.
That's what I thought.
And what happens is, when you work with our office, there's an IRS form. There's always a form to get out of things. IRS form 5329, which does allow you some relief.
to
right?
explain why
Right.
you did.
Explain why you didn't take it. Show the steps that are being done to rectify it.
Okay.
But by and large, we don't want clients to go through that because that's a troubling time, and you don't want to be messing with that.
That's right.
Yeah.
That's right. Okay. Well, let's shift the discussion then. I'll go into what we call a qualified. Again, we have all these acronyms: QCDs,
Yes.
Qualified Charitable Distribution.
Yeah.
I think it was something that was put into IRS code back somewhere around 06, 07, or maybe, I'm sorry, 06 was when it was officially made a law.
Right.
Back in 2015. They called it the Protecting Americans. They always have these acronyms too. PATH, Protecting Americans from Tax Hikes, made a QCD, or Qualified Charitable Distribution, permanent.
Right.
So folks can do that. And basically, what does that mean? Why would I want to do a QCD, Qualified Charitable Distribution?
Yeah, this is something that's taken off in popularity over the last few years. And so what a QCD is, and like Bill said, a Qualified Charitable Distribution, what that is it's where you never get the distribution as the taxpayer. So that distribution, it does not come to you, and that's an important step in all of this. And you want to make sure that you're never getting the money.
Yep.
It's going right from you to the charitable organization.
Okay.
Right. So why would I want to do that, and who would be a good candidate for this? So let's think about where we're at with the standard deduction now. So the standard deduction, and I'm gonna pick on people over 65. So that's about $32,000 in a standard deduction, and that's just
standard plus additional
right.
over 65.
So the IRS is just giving you $32,000. So you get that. And then you think about what makes up, right? There's always this argument of standard versus itemized. What makes up an itemized deduction? So the itemized deduction are your medical expenses, your state and local taxes, your real estate taxes, your mortgage interest, which if you're paid off, you're not getting that,
Yeah.
and then your charity. So what we see is this space where there's people who maybe they're donating $15,000 a year, but they've got a paid off house. They're not getting the benefit of the itemization on their return. Because they're getting their $32,000 free. So they're not getting that, but they still want to be charitable. They want to support organizations like the Hospital Foundation, their church, Red Cross, all these good organizations. And we're trying to say, what about this RMD? Remember, we talked about that a couple minutes earlier. I have to take that. What if I just donated that to the charity?
Gotcha.
And so what the mechanism of the QCD allows is it doesn't get into your adjusted gross income.
Okay.
So let's use an example there. So let's say my RMD is $50,000 for the year.
Okay.
Right? And let's say I make the choice to do a qualified charitable distribution of $15,000.
Okay.
Right? So that $15,000, what that means to me is that does not count as income to me.
So just to back up for a second, you would call your financial person, whoever's handling your account. You would tell them your intentions. You say, hey, I'd like to give X number of dollars. It could be $5,000 here, $5,000 here.
Yep.
So it could be 3 or 4 different organizations that they would like to donate to for the year.
No limit on the number of organizations. The only limit is the aggregate contribution or distribution in this case.
Sure.
So it's going to be $105,000 for this year.
That's right, because
per person. You get your extra $5,000. So
it was 100. Now
it was 100. It's 105 this year.
Okay.
So and that's per person. So for a married couple, provided they meet the requirements, right? They each need to have their separate IRA.
Sure.
Spouse 1 can do 105,000. Spouse 2 can do another 105,000.
Wow. Okay.
So what you really need to do is you need to work with a financial professional such as yourself to say, do I need this money, right? Because with the RMD, you have the ability to take that money out, put it in your bank account.
Sure. Pay taxes.
But if you're living okay, you're still going to do the charitable contributions anyway. You're not getting a bang for your buck in the standard versus itemized. Maybe the QCD does make sense because a staggering number, I think it's right around 90% of U.S. taxpayers are now taking the standard deduction.
90%. You know, I remember Martha saying a couple years ago, somewhere around 65% of her clients.
Right.
And I'm sure you're seeing that with your clients as well. And wow.
Yeah, and now maybe in 2024 that comes down a little bit because the mortgage rates are so high right now that you know, people are paying more in mortgage interest. But you know, there's a good majority of Americans that now take the standard deduction. So I would say look at your tax return, see if you are taking the itemization or the standard deduction, and maybe a QCD does make sense for you.
Gotcha. Yeah, we have it happen all the time where, like I said, clients want to take a certain amount, but we emphasize you can't just take the check.
Right.
You can't take an RMD and then turn around, because that's the same thing as trying to itemize. You know, it's you take the check made payable to yourself, you take your RMD, then you write the check to the organization. This is not the same thing. I just wanted to clarify that. It cannot be made to yourself.
So the financial advisor or whoever is administering that retirement plan, they will need to coordinate with the charitable organization, and then it goes right to them. And then what happens is, you know, on your tax return or when you go get your source information for the year, you're going to get your 1099-R. That's where the retirement distributions come from. That's how they're reported to the IRS and yourself. And what happens is we show the gross amount, but then we reduce it to a net amount by the amount that you donated to the charity.
Gotcha.
And then so even on the tax return, there's a little QCD designation. So you see that on returns. And now what that allows the IRS to know is that, you know, yes, they did not pick up the income, but they don't get the charitable deduction. And then what we always do as a best practice in our office is make sure we attach the charitable letters that were paid from the QCD to the organization.
As a record keeper.
Yes.
Very, very good.
Yeah, kind of helping the IRS do their job a little bit.
Yeah, good.
Yeah.
How about a Roth? Does someone have to take RMD, required minimum, out of a Roth IRA?
All right. So Roth, no. No.
Okay.
So with Roth, you're okay, and I mean that's part of the advantage of the Roth. And you know, when you're speaking of Roth, you're speaking of, you know, post-tax dollars that are being made, right? And that's part of the attractiveness of the Roth is that, you know, I don't have to take that RMD. And you know, by and large, I would really recommend that you know, these QCDs that we're talking about here, they should never be done by a Roth. I mean, what we would like to see done are out of an IRA. Out of a simple IRA, out of a SEP IRA. You know, QCDs are not allowed to be done by 401ks. And I know that's something that happens if people have their funds in a 401k. They go to retire, then they start taking distributions, but it's got to be out of an IRA.
Gotcha. So they need to move it to an IRA.
Right. Right. And I think that should just be said right now. I mean, I think this is always a time of year, right? We're getting into the holidays. We're getting into the New Year's resolutions. You know, I would challenge everybody that one of their New Year's resolutions, look at your retirement accounts. You know, are they being managed? Are they being taken care of? Do you remember where they're all at? I mean, people switch jobs from time to time. You want to make sure that you have a handle on everything.
That's a good point, because we do see, you know, some of the stories I'm sure you've seen, we've seen, is clients have multiple accounts, and, you know, RMDs have to come from
the aggregate.
People think they have to take 500 from this one, 1,000 from that one, and as long as it's let's say four IRAs together, right? They can just take it all from one. Is that correct? Okay. I mean, I knew the answer to that, but I just wanted to verify.
And I mean, that's an important thing, and that's a callback to when I was talking about the self-directed funds. Those go into the pot for the calculation.
That's right.
So you really want to make sure. I mean, I always think this is a good time of year to take inventory of your financial health and go back and look at the retirement accounts and see, you know, do I have coverage on all of them? Maybe check the beneficiaries. Do I actually have the beneficiaries that I wish on those accounts?
That's a good point, Jim, because I had that happen a few years ago. I remembered looking at a client's TSP, and I happened to see there was not a beneficiary listed, and he checked into it, and sure enough, you know, somehow or another they had no beneficiary listed. So that was a good point. So very good point. So Any other thoughts on that? I mean, as far as like stories that you can think of where, it would make sense for someone, I know we talked a little bit earlier, standard deduction versus itemized, but is there any other points you'd like to make on the QCD or anything?
So on the QCD, I mean, another big thing that we're seeing with our clients right now is Medicare premiums. So old IRMA, right? So that's the write that one down because we just call it income related monthly adjustment amount.
Yes.
So in layman's term, what is that, right? What the IRS does is, or what Medicare does is they look at your modified adjusted gross income. So what is that?
Yeah.
That's basically your line 11 adjusted gross income on your return plus any tax exempt interest.
Okay. So money market accounts where they have, not money market, excuse me. Municipal bonds.
Yep, exactly.
Yeah.
So they're bringing that back into the calculation. So you're not getting it taxed on it at the federal and state level, but it is part of the calculation. So why does that matter, right? I mean, what this allows us to do, this QCD, we're taking the RMD amount and we're not counting it into that equation. So again, if we go back to our example where we took a $50,000 RMD and we gave away $15,000 to charity, now our income is only $35,000. So instead of having that whole 50, which could bump us up into the next bracket of IRMA.
For IRMA, yeah.
Now it's only 35.
Okay.
So just something to think about that we're seeing it more and more in our office where that's the first question out of people's mouth is, what IRMA bracket am I in?
Yeah, we see that quite a bit where folks are paying almost double, what the 175
right.
change,
175 all the way up to almost $600 a month.
Yes.
So when it is tiered, almost like the way we have our tax brackets.
Yes.
It is tiered. But you can go through those, and it starts right around $103,000 for a single person.
Okay.
$206,000 for a married couple.
Married couple, yeah. Yeah, and that IRMA is good old Medicare. It's a 2-year look back.
So 2-year look back, very important, right? So all the decisions we make today will impact 2026.
Yes.
And as Bill and I are sitting here recording this video, it's 2024 right now.
Yeah.
So all your premiums are based off the 2022 tax year. So
yes.
We always talk in the office about what can we do now to set the successful future. This is one of those things, right? Really paying attention because these premiums are eating people up out there.
Yeah, and when they take, like you said, it's all income, so they're taking money out of their retirement accounts, and that's income, even though it's not earned income.
Right.
It's income.
Yeah.
And that counts as IRMA.
Yeah.
That counts towards IRMA. So.
Yeah, exactly. So I mean, I think it's just something to pay attention to, and I think this is a good way that we could save on the monthly payments that are having to be made for Medicare.
Good. I'm glad you brought that up because that's a real big one out there that we see quite a bit as well. So, one other piece that I think clients, folks out there, not necessarily that familiar with are donor advised funds.
Okay.
A little different than a QCD, but if people have larger charitable intentions, I think it makes sense to do that. I don't know if we want to talk too much to that because they can be complex a little bit.
Certainly. I mean, donor advised funds, or everything's an acronym, DAF.
DAF.
So the donor advised funds have taken off in recent years as well.
Okay.
So where I see the DAF have the most utility is someone who's in a high tax bracket, and maybe they're at retirement age. So an individual, and I've had a couple this year where they've got large retirement payouts. So they know that their income is going to be very high this year, but they know that next year their income is going to substantially drop because they're retired, they're not taking Social Security yet, and they're not subject to these RMDs.
Okay.
But these individuals are also very charitably inclined.
Okay.
So maybe they're giving away, let's use a round number, $50,000 a year in charity. Mm-hmm. One of my recommendations is do it through the donor advised fund. And what happens and what the mechanism there is that you get the donation the year it's made. So let's say I do a donation of $250,000 in a year that I have really high income.
Sure.
I want to match the high income year to the high deduction year.
Yes.
So in the year of the donation, I get the $250,000 donation.
Yeah.
Then what happens is I can say, oh, I'd like to give the Boy Scouts $50,000 in year 1.
Yep.
Church $50,000 in year 2. Red Cross in year 3. You can bide your time a little bit and have the flexibility.
And all these, and it grows.
It grows. Yeah. So I mean that's something we're seeing a lot at the strategic level is I call it marrying up.
Yep.
You marry up the high income year with the high deduction year.
Yep.
Because they're not going to stop donating to the charities.
Yeah.
But what happens is they may be trapped up in the standard deduction world the next year,
Mm-hmm.
or that donation that they got a value of call it 37 cents on the dollar in the high income year.
Yep.
Now the next year it's only worth 10 cents on the dollar.
Okay.
So just a way to think about that. So if you are an individual and you have a larger income year, now may be the time to do it.
Okay.
It's a pretty simple process, right? I mean, you work with a financial planner such as yourself, right? The client would call you. I'd give the recommendation. They call you, and where do they go from there? How do they?
Well, basically, at that point, then open up an account just like they would any type of retirement account. It's a DAF, donor advised fund, and then at that point, like you said, we would take direction from them as to which organizations that they would like, just like the QCD. We need to know exactly where the check is going and where they'd like to give their charitable contributions or distributions, however you want to say it. But
And then another important thing there is just that you get the donation the year you put it in.
Mm-hmm.
You don't get the donation when it comes from the donor advised fund to the charitable organization. So that's something I've seen a couple times in practice.
All of a sudden you get a call that says, "Well, remember 2 years later they want to take I gave $10,000 to CalvertHealth Foundation maybe and." I want to take a deduction. Doesn't work that way.
No, it does not work that way.
One time, I like how because that makes more sense. I mean, it's in a year where you're taking high income with a higher deduction, marrying those two. I like that. That's definitely
that's a strategy we like to use.
Good.
Yep.
Well, I know next year we've got we've got new administration coming in. I mean that right now the law is supposed to sunset as people hear that word and they know, what does that mean? Sunset, essentially 2025, unless they make a change. The last year for the current tax law is 2025.
Right. So we were.
So by 26, they'll go back to 2017.
2017 rules. So we're going to get in our Wayback Machine, and we're gonna time travel back into the year 2017. So a month or so ago, there was a great amount of uncertainty in our office. We were trying to figure this out. I mean, when we think about the sunset, the first thing that comes to my mind, likely yours as well, is the estate tax exemption.
Yes.
Right, so we're at 13.6 million right now, ballpark, for an individual. So that's 26 million for a married couple. And that was set, and it still is set right at this exact second, to be cut in half.
Yeah.
So that would be cut in half.
Back down.
Meaning, So, given the election results, I mean, I think some of the commentary I'm reading says that likely going to just stay status quo, but it is something to still be worried about. I mean, that's a large chunk of the sunsetting. Some other things that we probably don't remember from 2017. Personal exemptions would come back.
Okay.
The standard deduction would be a lot less.
Yes.
Because you get those personal exemptions.
Yes.
Right? I mean, I'm trying to think of different things. Home office for an employee.
Yes.
That went away. Yes.
If you were a traveling salesperson.
All that stuff went away for W-2 employees.
Yes.
Back in 2018. So there are some big tax rates would potentially go up. So that begs the question, do we do some of these income items in earlier, right?
Yes.
Do we do it this year? Do we do it next year?
So right now, 2025 is the last year, unless they make a change. Which I think we're all sort of assuming there'll be some sort of changes to the law, and at least re-amending it, if you will. I guess so they'll probably come up with some new name for it.
Yeah, and that's the thing. It does need to be approved to continue.
That's right.
So right now, it is currently set to just sunset. So if everybody just puts their hands up,
It goes away.
A year from now, it just goes away.
Yeah, 2026 is the new
Right.
year where the 2017 laws come back into play.
Right,
Yep.
right. So I mean, we'd have things like AMT, alternative minimum tax,
Yes.
like that would come back. It never, I guess, went away per se,
Yes.
but the exemption amounts were so high that there's a large number of individuals that are no longer affected by it. But things that could come back, we just need to keep our eye on it, and that's what the team and I try to do at the office is just keep up on this. It's one of those things. How much do you always want to be conversant. Yes. And keep your eye on it. Good. So, but I think that's something. But this estate tax is something that I do think could still be an issue down the road.
Yeah.
And what I would encourage people out there to do is that you are able to give $18,000 this year tax free to another individual.
The gift tax.
Yeah, the gift tax.
Or the gift.
Right. So you're
people
using.
Think we can talk about that too, but essentially, the gift tax. Go ahead.
Right. And I think what you're saying there is, there's this misconception out there that if I gave Bill some money right now, he's going to pay tax on it. No. The only time it's the donor is the person who bears the responsibility. And usually what that means is just reporting the gift, right? So if I made a gift over $18,000 to you, mm-hmm. I would need to report that. And there's no income tax per se associated with it. It's more a reporting mechanism because we got to remember that $13.6 million is for gifts during your lifetime or when you pass away.
Yes. Yes.
So what the IRS is, they like a nice paper trail. They like to see that you've used your exemption during your lifetime.
You gave me $25,000. That extra $7,000 because you were over the limit of 18.
Right.
Goes
to use against my 13.
Your exclusion of
yes.
your 20. Yeah. So because we do get that a lot where folks think they have to pay some sort of tax on it or the person they gift it to, their kids or grandkids or whoever.
Right.
So, okay, very good. Let's talk a little bit about, I know folks a lot of times like to donate a stock instead of actual cash, right?
Yeah.
So that's one option, right?
Right, yeah.
Can you talk a little bit more about that and how that works?
Sure. I think that's something, again, that we're seeing in the last 10 to 15 years take off because the market has done so well,
yep.
right? So now people are looking at their portfolio and they have these large positions with unrealized gains in them. And what we look at as the CPA is, I think that's an asset that I would donate. So what happens is, you donate a stock, and we'll pick on Apple for a second. So we donate an Apple stock that we're very highly appreciated on.
Okay.
And what I mean by that is, we bought it for $10, now it's worth $100. So we have a $90 unrealized gain. So what I can do is I could donate that share of Apple to a charitable organization.
Okay.
And now you'd say, well, why would you do that? Because now what that does is I don't have to pay that $90 gain, that
Capital
delta.
Gains, yes.
Yeah, it sort of goes away.
Yes.
And then what happens is when I make that donation to the charitable organization, I get a deduction of $100. So it's the
versus
fair
what you
market
paid.
value.
Yeah.
Right. So it's a good way for people that if they are thinking, well, I don't want to take my dollars out of my account. Also, you can think and maybe take a stock or two out of the account and meet your charitable giving in that manner.
And that's going to be outside of a retirement account. You're referring to maybe like a
right,
a
right.
brokerage
yeah,
account.
So
taxable.
yeah, so this
just
is
to clarify.
Yeah, yep. So if you have a taxable brokerage account, this is something to think about.
Yeah, like you said, Apple. We picked on Apple, but Nvidia is another one.
Nvidia,
that's run like crazy. Right. Tesla.
Exactly.
There's
a bunch of them out there.
Yeah,
and I think it's just, again, this is where you work with your financial advisor, you work with your CPA, and they're able to advise on what stock would I donate, how much, because you got to remember, and I got to give the cons sometimes. When you do a stock donation, it is subject to a 30% adjusted gross income limit.
Okay. Got
So
it. Good. Glad you-
yeah, just something to remind yourself with. So we want to think, am I getting the whole bang for the buck this year? Charitable contributions do carry over 5 years,
Okay.
so it's not like it's all lost.
Okay.
But it's just something to think through when you're working on the
Good.
planning of how to make these donations.
Good. Good. Well, we thank you again for another successful financial wellness series. We wish everyone out there a very Merry Christmas and a wonderful New Year. We know that's right around the corner, as you can see with our decor right behind us. We're already in the Christmas spirit here right before Thanksgiving. So again, we thank you for tuning in, and we recommend any questions, reach out to our website, which is CalvertHealthFoundation.org. If you would go to that website, there's a lot of useful information, or feel free to reach out to the foundation office, which will put the information on the screen. Thank you very much.